Welcome to the deep dive. Today we are grabbing our financial analysis toolkit and really going deep into corporate reporting.
We are.
We have a stack of source material here spanning decades, from these, old school financial frameworks to the modern reality of cash flow. And our mission today is pretty simple: to kind of hack the matrix of corporate finance.
Yeah, to find what's really going on.
Exactly. To find the true, unvarnished financial health of a company.
That's right. Because if you're just relying on net income, you're really operating with incomplete data. Accrual accounting is, look, it's a fantastic measure for long-term performance, but it can obscure the day-to-day reality.
Good liquidity crunch.
Good liquidity crunch, exactly. We have to go beyond just the glossy headline numbers.
So we're building the sophisticated analyst's toolkit today. We're going to start where most valuation begins, right? The
Yeah.
ultimate measure for shareholders, return on equity.
Mm-hmm.
But we're going to quickly show why the modern reality, the statement of cash flows wasn't even standard until 1988, demands a totally different way of looking at risk.
Our journey is really going to take the three key pillars of analysis: profitability, efficiency, and risk. And we'll use a framework like DuPont to break them down.
Okay.
But the real insight, the place we really want to get to, is when we pivot from those historical frameworks and layer on the cash flow ratios. That's what reveals what management is truly dealing with.
Okay, so let's unpack that. Everyone knows return on equity, ROE. It's the profit you generate for every single dollar of shareholder equity.
Right.
We saw an example, the Chevio company, boasting a spectacular 60% ROE. That sounds amazing.
It sounds incredible.
But if you stop there, you have missed the entire story.
You absolutely have. Because if that 60% ROE is achieved with, say, razor-thin margins and just a mountain of debt, it's not an investment thesis.
It's a time bomb.
It's a ticking time bomb. The power of the DuPont framework is that it takes that ROE and it decomposes it. It forces you to look at the quality of that return.
So that famous decomposition breaks it down into, what, 3 specific drivers?
Correct. First up is profitability. That's just net income over sales.
Yeah.
How much profit do they squeeze out of each sale?
Okay.
Second is efficiency. Sales over total assets. How well are they using their stuff, their assets, to generate those sales?
And the third one is the kicker?
The third one is leverage. Assets over equity. This is the risk amplifier. This is the dangerous one.
So if we look back at that Chevio 60% ROE and we realize, 80% of that return is driven purely by extreme leverage, that third component, it completely changes how you judge it.
Totally. It transforms ROE from just a bragging right into a diagnostic tool that's flashing a big red warning light.
So it's not just a number, it's a process.
It dictates the entire investigative process. Instead of just accepting the number, you have to follow 4 steps. Identify the metric. Okay, ROE is high. Decompose it. Find out which driver is responsible. Then investigate the specific sub-ratios, and finally, interrogate management. Ask them about their strategy. Is that high leverage sustainable?
That interrogation point brings us right to that high-risk component, leverage. This is where it gets really interesting, because this is the tool that can magnify returns when things are great.
Mm-hmm.
But it bankrupts the company the second things turn sour.
Exactly. So to measure that static risk, just how much debt a company has on its books, we look at what we call stock measures on the balance sheet.
And there are 2 main ones, right? Debt ratio and debt to equity. They basically tell the same story, but on a different scale.
Yeah, that's a good way to put it. The debt ratio, that's total liabilities divided by total assets, gives you the percentage of assets financed by creditors.
Okay, so for example?
For instance, Walmart has a debt ratio of 65.5%. That means creditors are financing almost 2/3 of their entire asset base.
Yeah.
Target is even higher, I think 72.3%.
Wow. Okay, and then the debt to equity ratio just frames that relationship a bit differently.
Right. It's total liabilities over stockholders' equity.
Hmm.
So for Walmart, their debt to equity was 1.9. That means they borrowed $1.90 for every single dollar put in by shareholders.
And the key here is context. A company like Walmart can handle that.
They can sustain that because they have very predictable, reliable assets. Inventory, real estate. They have strong collateral and steady cash flow, so banks are comfortable. A volatile tech firm couldn't get away with that.
So as an analyst, you have to be super clear which one you're using.
Oh, absolutely. It's like clarifying Celsius versus Fahrenheit. You have to be speaking the same language.
Okay, so that covers the static risk, how much debt they're carrying. But if you're a lender, you care less about how much they have and more about, can they pay it?
Can they service the interest? Yeah. This is where we move from a balance sheet stock measure to an income statement flow measure of coverage.
And that takes us to the classic benchmark, times interest earned, TIE.
Right. TIE. It's simply earnings before interest and taxes EBIT divided by the interest expense. It tells you how many times your operating profit can cover your interest bill.
And you want a high number. A tie near 1 is the danger zone.
You're one bad quarter away from distress. Yeah.
We saw one calculation for a Petrini company where their tie was 139 times. I mean, that's incredibly safe for creditors.
It is extremely safe. Banks would be lining up to lend them money at, super low rates.
Mm-hmm.
But if I'm an analyst, I'm actually a little skeptical.
Why? Too safe.
A tie that high could suggest the company is dramatically underleveraged. They might be missing huge opportunities for growth because they're not using their capital structure efficiently. They're being too safe.
Oh, so that's the difference between just checking a box and doing real analysis. The number 139 isn't just good, it's a prompt to ask, why aren't you using more cheap debt to grow the business?
Exactly. And even a small change matters. DuPont, for example, saw their tie decline from 9.46 to 7.71 in a year. Still very comfortable.
Well, safe, yeah.
But it's a signal. Either their debt costs went up or their operational earnings were under pressure. It tells you where to dig.
So we've used all these traditional ratios, all sourced from accrual accounting. But this brings us to the core issue, right? The source material reminds us that ratios highlight, they don't diagnose.
And that the analysis has only just begun.
Right.
If we connect this back to the bigger picture, we hit this massive analytical blind spot. The traditional model was created decades ago, and it relies entirely on accrual-based net income.
Because there was no mandatory statement of cash flows?
Right, not until 1988. And this is a huge problem because net income can be, it can be deeply misleading about a company's immediate ability to survive, the cash reality.
This is where we need to bring in that modern sophistication. Cash flow analysis is the reality check, and net income can lie to you in, at least 3 major ways?
At least 3. The first, and it's the most benign, is the presence of large non-cash expenses.
Like depreciation.
Depreciation is the classic example. A manufacturing company with huge depreciation charges, their net income gets hammered. It looks terrible, the stock might even drop, but the underlying cash flow from operations,
Untouched.
completely unaffected. The company can still pay its bills just fine.
Okay, and the second scenario is what you see in tech all the time. The cash consumption paradox.
Yes.
Yeah.
The high-growth company, they might report positive net earnings, right? They made sales, sent invoices, but if they're consuming cash faster than they generate it...
By building up massive inventory, or their customers take forever to pay.
Exactly. They're waiting months for those receivables.
Mm-hmm.
So they are profitable on paper, but they are cash poor. They look like a success, but they're constantly running on fumes, needing more funding just to keep the lights on.
And the third scenario is the most worrying one. Window dressing.
Management often has strong incentives to inflate accrual earnings, especially before a big event.
An IPO, a big loan negotiation, bonus season?
All of the above. They can play with assumptions about reserves or warranties or how they recognize revenue to boost that net income number. Operating cash flow, though, that's much closer to just what's in the bank account. It's the cash in versus cash out.
It's just much, much harder to fake.
It is. It's the superior reality check.
Okay, so this is the moment. This is where we separate the basic analyst from the sophisticated one. We need to look at the 3 cash flow ratios that absolutely have to be in your modern toolkit.
Starting with the cash flow to net income ratio. It's just cash from operations divided by net income. And its whole purpose is to quantify the impact of management's accounting choices.
For most stable companies, we'd expect this to be, greater than 1? Mostly because depreciation gets added back.
Exactly. And stability is what you're looking for.
Mm.
If you see this ratio moving around wildly year over year, it's a huge red flag that the gap between their cash reality and the reported earnings is getting wider.
And the DuPont case study was a perfect example of that.
A perfect example. Their net income dipped, which was the negative headline, the bad news story.
Right.
But their cash flow to net income ratio actually increased from 1.47 to 1.72.
Okay.
That increase was the critical insight. It strongly suggested the lower net income wasn't from operational failure, their cash engine was fine, but from more conservative accounting judgments that year.
The cash story was actually healthier than the accrual story.
Fundamentally healthier. It's
Yeah.
a huge analytical advantage to spot that disconnect.
Okay, let's talk about self-sufficiency. Funding growth. The cash flow adequacy ratio. This seems crucial for understanding how a company can finance its own future.
It is. It measures their ability to fund all their investing. So, capital expenditures and acquisitions, using only the cash they generate internally.
So cash from operations divided by cash paid for those investments.
That's it. And if you're above 1.0, you're funding your own growth. You're a true cash cow.
And if you're below
You're
1.0,
reliant on the capital markets. You need to borrow money or issue stock just to maintain or expand your operations.
the green company example was off the chart, something like 16.
16.36, yeah. They're just swimming in cash.
Mhm.
But looking back at DuPont, this ratio was a game changer. It jumped from 0.62 in 1 year, meaning they had to borrow to fund investments.
A cash user.
Right. To a remarkable 2.68 the next year. This confirmed that regardless of the messy net income number, that company was generating plenty of cash to fund its own expansion in 2012.
Finally, we need to apply that same cash reality check to risk. We talked about the traditional tie ratio, but for the true picture of safety, we need the cash times interest earned, the cash tie.
This is the true margin of safety for lenders because it uses actual cash flows to see if interest payments can be covered. We're stripping away all the non-cash noise from operations to see the raw cash available to service debt.
It's the survival money.
It is. And it's always a more conservative, harder to fake number than the accrual tie. The comparison tells you so much. Walmart, with the accrual tie, looks safe, but their cash tie was 12.7. Target's was 16.9.
Which is phenomenal.
Phenomenal for creditors. It shows they can weather serious downturns and still easily meet their interest payments many, many times over. This is the kind of analysis that fundamentally informs credit risk and bond ratings.
So that brings us to our final summary. We started with the old school ROE, used DuPont to understand what was driving it, and then we layered on this indispensable cash flow analysis. And by doing that, you answer the fundamental questions that net income alone can never resolve. Is this supposedly profitable company actually generating cash? And can this company fund its own growth without constantly going back to the market for money?
And this raises a really important question for you, the analyst, about whether all this deep effort is actually worth it. We constantly hear about the efficient market hypothesis.
Right, the idea that all this public info is already priced into the stock, so what's the point of the deep analysis?
It can feel like you're just confirming what the market already knows. It can be discouraging.
Sure.
But the academic research consistently challenges EMH in this specific area. The kind of deep, sophisticated analysis we've talked about today, comparing cash tie to accrual tie, using that cash flow to net income ratio as a diagnostic, has been empirically shown to predict future stock returns.
So it actually works.
It allows analysts to achieve abnormal profits. The market is not perfectly efficient when it comes to this stuff.
So your takeaway is clear, and it's validated. The difference between just reading the headlines and performing true business intelligence really lies in these details.
It does.
The shift from a simple debt ratio to understanding the full implications of the cash flow adequacy ratio, that is the advantage you have. And now you know exactly where to look when everyone else is still just debating net income.